the truth is, that was in November where rates peaked, mortgage rates peaked in early November. Well, they're down 90 basis points since then. Okay, that doesn't really help you a lot. Junk spreads, down 150 basis points since their peak in early October, late September. That doesn't really do a lot for you if you're the Fed. The 10-year Treasury, which you see every day, down 60 basis points. Well, that doesn't do a lot for you if you're the Fed. All these different things being easier since then, obviously the stock market since those 3,600 lows, up near 10%. Well, that doesn't do much for you if you're the Fed. And by the way, talking about how much the market's down or not down, since 19, before COVID, we probably got 7-8% annual returns till this point right now where we're sitting. That's not so bad, Joe, I mean, historically. Now, this year's not good, but the last 3 years, and I'm not talking the COVID lows, I'm talking 19, the end of 19, before COVID. I mean, we have reasonable returns for the last 3 years based on that rate. And, I don't know if 19 was exactly the end of 19. What do you exactly call a low point in the market before COVID struck? So, I'm looking at that, and we don't have coordinated tightening around the whole world and everybody tightening at the same time too often. You just don't. And I don't have people telling me they're going to go further tightening. You just don't. And they don't tell me where they're going to go too often. And you just don't. And I don't have 2 years and 2 years here below where they tell me going to go if they go that way, on average, so far below it. You just don't. So I have these, you want to call them, and I understand that you get other people saying inflation's down and they should do this and they should do that. Well, they're telling me what they want to do, and they know all this stuff that all these other people do because they're worried about this other underlying mismatch in the labor market, I think. That they're worried about that. They may be worried about other things, but just they don't want inflation to take hold, and they don't want it to get higher. You don't want to have a steady state that you think after you do things of 4% or 4.5%, 4% call it. They want inflation at 2%. So they're looking at beyond when inflation comes down from 8% to, it's going to come down to 4% or something like that. They don't want a persistent 4%. They want to get in front of that a little bit because they're fairly nervous about that. They're nervous about it. The BOE is nervous about it. The ECB is nervous about it. So it is what it is. So you're supposed to always hold stocks and look through these things and own for long term, to a certain extent. So that means if your stock portfolio is you range your stock portfolio from 50 to 60% long to 90% long, you should probably be less long. That's what that means to me, because the average person should not be moving around things. And I keep some things because of taxes and other reasons. Warren Buffett would always keep things forever, so he doesn't have to pay taxes on it. But for me, as a hedge fund manager, I'm going to lean short. I'll be short bonds, and I'm like generally an optimist. I have just the way I just have that sort of lean that way. So it's like I would probably say I'm leaning short on the equity markets. Right. So right now, because I think I think the upside downside just doesn't make sense to me when I have so many people telling me, so many central banks telling me what they're going to do, what they want to do, what they expect to do. It has to, and everybody, people come on and say, well, this is going on. They know that stuff, but they're worried about the underlying stuff. And so you have to worry what they're worried about. And by the way, if you think that they're wrong, out there because it's going to go down, well, maybe they'll cause, and maybe they realize it. And I don't know what they're saying because they can't say it, but maybe there will be a small recession of some sort and will affect prices. And, with the market, listen, you see these, I saw somebody else on your show the other day, they had a 220 price target, 220 earnings estimate for the S&P. Well, these interest rates, it's kind of hard to have a higher, they were putting a really high multiple, and I'm saying, why am I still putting these high multiples of like when I had 1% rates on these things? I got to put multiples to realistically of the market. So that's the question of the stock market right now. What should be the multiple? And Joe, you've been around for a lot of markets, not to give your age away on TV, but these multiples, what should the multiple be? We lived through multiples of for instance, when we were talking 2010, the multiple was like 11, 12 back then, okay? Coming out of 2009 and those rates. To get to, this multiple now is, If you had 225 times 16 is 3,600. I mean, I'm not suggesting 225 is right, and you can see what people are forecasting on your show. You know, if it's a 16 multiple, you know, in those days, you would have said, great. Going from 2010, we talk about those days. I go to 12 to 16, that's a 33% increase.
Right.
In multiple.